Guys, welcome back. In today's video, we are talking about Grok predicting squeeze price, working out the float, the major catalysts, and many more in this video. First, we're taking a look at this. I asked Grok what the short squeeze price per share would be if there was 19.64 extra AMC share float, modeled after the GME short squeeze dynamics from Jan 2021. AI's answer, $2,000 per share at peak, but it acknowledges the price is likely to go even higher. And so this was, just like we said, using the float, which we'll talk about later on, using it with a previous model we've seen from GME, how high can it go? And the Grok's prediction is that it goes to 1,977. And that isn't including the momentum it will gain. This is purely based off of their model and what they think it is. But when you talk about when AMC price actually goes to 1977, there are going to be even more sentiment involved. There is going to be even more capital involved, which will obviously bring the price even higher. Ultimately, what we can know is that this is an uncontrolled short squeeze when it happens. No one will be able to stop it. No one will be able to control the price. And so this is from Grok's model, from an AI's model, but we have to include human sentiment as well. Now, this number is obviously based off of a very big factor, which is the extra float, the 19.64, the hypothetical synthetic / FTDs to cover. So why do we think that there is an abundance of float? Now, we've already talked about this before. We see various amounts of data. The AMC float can easily go into the 100x because of what we've seen. And so with this, we're only looking at 19.64 extra float, not to mention if this was going to be 50, 80, or 100. So firstly, let's talk about some of the reasons for why we know that there is so much shit float out there. Firstly, if we take a look at the AMC short shares availability, you can see that this is reducing. So this is showing that people are in need of AMC shares. They are borrowing, they're shorting AMC. Now, one of the biggest reasons for why this is a giveaway to why we know there's already an abundance of float is because every time we see this, firstly, we have to realize AMC is already issuing out 100 million shares or something similar to that, and there will be an abundance of shares, or at least people claim to be so. Yet we are still seeing people borrow shares. So this is why I said with how I don't think 100 million shares is going to let any short seller who've trapped themselves get out of this. And the reason for this is because there are already billions of synthetic shares. And now, what we can also see countless amounts of times as well is when we see 2.2 million shares go down to 8,000, sometimes you will see it bounce back to 2 million or 1.5 million, or it will just have a massive volatility in the shares availability. Now, a lot of the times we know that that isn't because they are returning the shares, but rather they've created more shares and put it back into the system, into the circulation. And this is why we've said that there are already hundreds of millions, and if not billions of shares, perhaps being created every single week, every single month. And so we talk about how long this whole thing has been, is why we can understand that we can be looking at 19.64 extra AMC flow, but we can be even looking at a way bigger float than what we are seeing right now. Another thing that we're looking at is the days to cover, which is increasing. Now, the thing why this is important is because we're seeing the short interest increase as well. Now, we already know that self-reported data cannot be trusted. At the end of the day, they are self-reported. Not to mention, offshore data doesn't even have to be reported. So we know that this is the very, very minimum. For me, I personally like to always times 10 what we're looking at. So the short interest shares would be 124 million times 10, 1.2 billion. The short interest percentage will be 27 times 10, 270. And the short interest ratio will be 3.06 times 10, so 30 days instead. Now, this is something that I have been using since the very start. Ever since we found out about self-reported data and we found out about all these offshore accounts that they use, not to mention all these offshore shares that we know and seen that exist, I have been using times 10. Now, this multiply could easily be bigger than what it is right now. It's just that for me, for people who've been watching these videos for a long time, who've been on this channel for a long time, we use times 10. But perhaps we could be looking at a times 50, times 100 right now, because of how long this has been going on and how many shorts they have created in order to suppress AMC. But because if we take a look at this as well, just to show another example for why the float has been sold so many times over, is that right now, Fintel shows institutions owns 54% of AMC shares, while retail owns 46%. So that would mean 0.46 times 513 million, which is the supposedly total float of AMC, it would show that retail owns 235 million shares. Now, we know that there are 3 million shareholders. So 235 million shares divided by 3 million shareholders would equate to 78 shares each. So they're saying that the majority of retail shareholders only owns 78. And it's just to say that we only need to own 78 shares to make up this 46%. Now, that itself is already very, very shocking, because we already know that apes own, in terms of average, way above 78. We have seen people coming out here who are apes, who are retail, who own tens of thousands of shares of AMC. We are seeing regular people even showing up with 1,000, 2,000 shares of AMC. And we're constantly seeing apes as well who are loading up 50 shares every single week. So to say that 235 million shares divided by 3 million shareholders will mean that everyone only needs to own 78 shares each, it just shows that that is not the actual data. And the only way for this to be possible, the only way for them to show a number like this is because of the existence of synthetic shares. And so this is why we know that the float is already so big, but it doesn't even stop there. So we've just talked about this using the shareholders. We just talked about the short interest data. We talked about the availability. Another big thing is the total return swap. AMC's real short pressure isn't just stock loans, it's offshore total return swaps tagged with UPIs. Forensic estimates shows 57 plus contracts, which equals to 1.7 billion plus synthetic shares, mostly invisible to US short interest metrics. And now this is one of the biggest reasons for why earlier I talked about why we times 10 what we are seeing here, and we should be even timesing a larger multiple than this. And it's because of things like this: 1.7 billion plus synthetic shares that are invisible to the US short interest metrics. So these are the data that we don't see when they report data like this, because these are offshore total return swaps. Now, bear in mind that this is a number that has been stacking up for a very, very long time, and it can get even bigger. There could be even some that are being hidden that we can't even find. But already here, we're looking at 1.7 billion plus. Now, these total return swaps are bigger than you think. Bear in mind, Credit Suisse, Archegos fell down to these very swaps. So we know these aren't easy positions to get rid of. We know that these can become extremely toxic. And so to mention that this is 1.7 billion plus, along with all of the other data we've shown, it already goes to talk about how many flows there are. And like we've said, this doesn't then even include tokenization, which we talked about before, and many, many more. And so to talk about, are we able to see 19.64 extra AMC float? I believe we can. Do I believe that it's even bigger than that? I also believe that. And just to show that with the calculation, 19.64 would equate to 1,977, and this is just based off of the calculation that Grok is doing, applying a model, not including human sentiment, the psychological levels for when we do get to 1977. It then should be even higher because the multiplier, the float, should be even bigger than what we are looking at, because you can see the multiplier is times by 19.64, which is the float, but this could be 50, this could be 100, which would then put this number to an even higher scale. And it's why we constantly see suppression like this, which is using the off exchange. You can see for the past couple of days for AMC in the off exchange, 80%, 77, 71, 74, 82, 81, 75, 81. And this is something that we've seen since the 15th of January. And this is how long it has been going on for. Now, it's very interesting that this is happening from the 15th of January, because if you go back to where we are seeing here, now this actually goes, the list should go even a bit further, but you can see that this happened when we had this run, and I've shown data already, during the 9th of January, we had 60% and we were up 13%. During the 12th of January, we had a 5.49%, and this was a 60% dark pool as well. And as we saw AMC go up by more than 18% in 2 days, suddenly on the 13th of January, we were met with 70% plus dark pool. And then we saw the price decline by 7%. And ever since then, you can see the price is declining whilst we're fighting back, whilst there are buyer pressure, but the price is declining. But what we are also seeing is what we talked about here with the increase in dark pool usage as well, going from 73 to days where we're even looking at 81, as you guys can see here. And so it just goes on to show how ridiculous this is and the suppression that they are using to suppress AMC. Now, another big thing to showcase why institutions want to buy and why, firstly, like I said, I don't believe that institutions own 54%, or at least I don't believe they own 54% of the real float, of the float that existed 5 years ago that have been bought up by the apes. But we do know that institutions are buying. Pentwater is one of the firms in example where they own a large percentage of over 40 million shares of AMC. Now, it's very important to know why these firms are investing into AMC, because people have always said AMC is an investment you should stay away, yet we're looking at these firms buying AMC. Now, Pentwater, if you take a look at some of the things for why they invest and their style, you can see catalyst-based event-driven hedge fund, where they look at merger and acquisition, capital raise, and take sizable stake when it sees a defined event path. And so this is the company that we talked about in the past before that have shown great results in the investments they're making. And the very reason for why they would normally invest, which we have pointed out here, and now the fact they're investing to AMC, especially with what we're doing, it showcases what is about to happen and why I believe there will be a major catalyst coming out very, very soon. Not to mention, Paramount is in discussion to nominate Pentwater Capital, a top Warner shareholder, to its board as a part of a proxy battle aimed at derailing Netflix takeover of the studio. And so we can see what their interest is, we can see what their understanding is, and it's why I've said that AMC is looking at very good investments. And even here, if UBS stake in AMC is what it appears to be, AMC presents a huge investment opportunity. And this is what we talked about, with, especially with what's happening right now and why people are choosing to buy AMC. Not to mention, AMC is extremely undervalued. We can see here the absurd near and long-term valuation of AMC. Its market cap is 632 million, but after stripping out its 428 million cash plus 27 million hyper of stake, the stub net equity value of the core business is just 176 million. The true enterprise value is 8.4 billion. AMC is massively undervalued. Now, everyone has their version of what they think AMC should be. Then this is talking about without a squeeze. But one thing that we do know is that AMC is undervalued. And it's why firms are buying so aggressively right now as they see the opportunity. We can see another example. State Street Corp reports a 12.7% increase in ownership of AMC. And they are someone which has owned over 11 million shares. It just goes to show why people are firstly buying, but how these media articles who are trying to portray AMC as a stock you should stay away, yet doesn't mention how these institutions are buying. Now, another big thing is this. What we're looking at from the 8K is a positive housekeeping step in AMC's debt cleanup, unlocks flexibility to refinance expensive short-term debt with hopefully cheaper and longer dated options. Now, everyone has their difference in opinions, and there has been two sides for this. I've already talked about how raising money allows them to obviously make the right investments, not only into assets, into infrastructure, but also operations as well. But we have to realize that if people are thinking dilution or these offerings are such a bad thing, why are institutions still buying? And the very fact that we are even seeing this fall and is trying to persuade people to sell, it just feels like we're playing into what they have wanted us to do the whole time. Because you have to see here, and while no one's talking about this, you can see more junk bonds. And Citadel was struggling to pay cat fees plus fines for misreporting. So Citadel raises 1.25 billion via US bond sale. So no one is talking about these bond sales, which they have done multiple times before. They have took up loans in the past before. And yet no one talks about this, and everyone's focus is on AMC. But it just goes to say, and it goes to show the position that these short sellers are in, and the fact they're trying to hide it away right now. And now we've seen in the past about these low rating loans that they are trying to take, and the very fact that this company, who is claiming to be making tens of billions of dollars, record profits every year, who are still needing to raise money, it really sends a message. Now another thing is for HYMC, which is where we are at right now. And you can see every time gold goes up by $100, HYMC measured and inferred resource increased by 1.4 billion more. A $100 ounce increase times 14 million ounce equals 1.4 billion. And every time silver goes up by $10, it's even more pronounced, an increase of 3.61 billion to 4.57 billion. So if you want to talk about the potential there is for Hycroft, here it is. Not to mention, what we're looking at is the open interest, is the settling that's happening, and what we are going to be looking at for the silver squeeze as well. Fun fact, when Volkswagen skyrocketed in 2008, naked shorts had more room to cover. So we're also looking at a major scale squeeze from silver as well. And it goes to show where Hycroft is going to be. And you can see at times like this, now we're seeing the Hycroft short interest increase as well. Not to mention, it should be even higher because they don't mention the offshore. And we're seeing the manipulation happening in silver right now. And it's why you understand we're also looking at a squeeze for silver. Now, as always, none of this is ever financial advice, so do take guys a grain of salt. Make sure you do your own due diligence research, and I'll catch you guys next time.